Hello everybody, I'm Walid Alavin, an insurance and investment broker, and today I want to talk about the mortgage insurance trap. Okay, so I'm going to paint a picture for you right now. You go to the bank, you go through your credit checks, get to know a mortgage agent, they get to know you, how much money you need for your house, your dream home, and you go through all the process, credit checks, reference checks, everything checks, boom, you're approved for a mortgage, your first home, you're so pumped. This guy says, oh, by the way, for an additional cost, we're going to try to insure this loan. So if something were to happen to you, your wife and kids want to pay off the house. It'll be paid off. You're like, shoot, I care about my family. I care about my kids. Why wouldn't I get this? I just fill out, there's a couple boxes there. Just fill them out, check the boxes, you're good to go. You doing okay, cool, I'm approved? Nice, nice. So you walk away, you think nothing of it, it's all good. Okay, so I'm going to ask you got mortgage insurance? They say, yeah, I do, I'm good. Fast forward about 5 years or so. You get a call, your spouse's call, you die, okay, you die. Spouse's call, oh, hey, Mrs. Dead Husband, you know, about that mortgage insurance, you didn't actually qualify for it because there's some inconsistencies between what your husband wrote on the application, and as we scrutinized the policy after he died, well, we found out that there's some things, the factual things that weren't consistent. So, sorry, we're not going to pay out the mortgage. And you're like, well, I've been paying for this for the last 6 years. What are you talking about? I thought I had coverage. And they're like, well, this is, and that happens. Okay, I got some case studies to show that happens, but that happens. Okay, this insurance is not ironclad. It's underwriting is done upon claim. What that means, underwriting is a process in which a company learns about a client potentially who is to see if they're insurable or not. So they do that after you die. So you don't know for sure if you're covered. You answer the questions and you should be good to go, but you don't know for sure. So if you're good to go, okay, let's say all is well. The bank's the beneficiary of that loan, of that policy, excuse me. The bank's the beneficiary of that policy. You have insurance, but the bank's the beneficiary. They just want to cover their own butts. So you do die, yes, your family doesn't have to pay the mortgage anymore, but that's all they get. The mortgage is done. But what about school, kids, toys, clothes, cars? If you got a lump sum of money given from a death benefit, don't you want it to go to your family so they can pay bills consistent with what they're doing right now? Not just the mortgage, it's not the only bill. Other than that, mortgage insurance, you pay an even premium. There's a declining principle. So the amount you're paying towards, or the amount of coverage you have, is declining as you pay off your mortgage. But you're still paying an even premium the whole time. It doesn't matter how low it goes. That's criminal to me. That's more bank profits, right? And at the same time, the banks don't tell you this stuff. Okay, the mortgage insurance guy, the mortgage broker, he knows about mortgages. He's licensed for mortgages. He's not going to tell you what he can't sell. You can't make a commission off and tell you what's better. That's what people don't understand. This is what you need to know. You need to have life insurance. Life insurance is a similar concept. The underwriting is done at application, so the company finds out if you're insurable now, so they're not going to get into paying for you unless it was a fraud or a suicide in the first few years. Well, those are small details. But what they do is this life insurance is flexible. It goes with you. Not the mortgage insurance. It doesn't go with you if you change banks. You got to reapply all the time. It goes with you. You have, once you're medically approved, you can transfer it, you can convert it to permanent life products, so you're always able to insure yourself. Because look at the same mortgage insurance. Remember, when you paid off the mortgage, there's no more insurance. It's done. It's finito. It's done. So 25 years after you buy your first house and you realize you have no insurance for your kids, for your funeral, for your last expenses, whatever, you probably can't even get insurance. And if you can, the premiums are going to be through the roof. So listen, it's education, people. That's all it is. It's just understanding that mortgage insurance is good for the time until you get to a life insurance broker, but it's not the be all and end all. And no one's going to tell you about it until you talk to somebody who knows better. The guy who you trust, who gave you a mortgage loan, is not going to be the guy you want to talk to about this. It's just a trap, guys. I'm telling you this straight up. This is just a trap. So you want to make sure your family is protected the right way, you're protected the right way, and you're not putting your money into something that's going to dissipate anyway. At least have the option to put your money into something that's going to be worthwhile for you down the road. So it's a trap, guys. Don't fall into the mortgage insurance trap. Your family's future could be at stake, guys. Have a great day. Feel free to talk to me or your financial advisor if you have any more questions. Take care.